A bond is simply a loan. Instead of a bank lending you money, you are the one lending money to a government or a large company. In return, they promise to pay you back with a little extra on top. This flowchart shows how it works using a UK government bond. Say you lend the government £1,000. They agree to keep that money for exactly 10 years. Because they are using your cash, they send you a 4% thank you payment every single year until that decade is up, at which point you get your original £1,000 back. But even seatbelts have limits. Bonds face 3 specific risks. First, inflation might rise so fast that your 4% return buys you less in the real world. Second, newer bonds might offer better interest, making yours less valuable to other buyers. And third, the chance that the company you lent money to goes bankrupt and cannot pay you back at all. That brings us to level 2, index funds. Imagine walking into a sweet shop with a single pound. Instead of risking your whole budget on one giant jawbreaker that might taste awful, an index fund lets you buy a tiny crumb of every single sweet in the shop. You're buying a small slice of hundreds or thousands of companies all at once. Statistics show that over a 15-year span, more than 90% of highly paid professional fund managers fail to beat the performance of these simple, broad index funds. The fees those experts charge eat away at their returns, leaving the simple, buy everything approach as the winner. Level 3 steps up to the ETF. While standard index funds only update their price once a day, an ETF is traded live on the market like a stock. That speed means you can buy or sell in seconds as prices flicker up and down, which adds convenience, but it also adds the psychological risk of reacting to every tiny market wobble. Using these bottom 3 steps creates an incredibly strong foundation. If you buy a global stock ETF and hold it inside a UK tax-free wrapper like an ISA, you shield your gains from the government. You set it, forget it, and let the broader economy do the heavy lifting for you. Level 4 moves away from the safety of the broad market and into single stocks. If an index fund is like backing the entire league, buying a single stock is like placing all your money on one football team. If they win, you win big. If they lose, you take the full hit. There are exactly 2 ways you actually make money from owning a piece of a company. You can sell your piece to someone else for more than you paid, or the company can decide to share a slice of its actual cash profits directly with you as a reward for being an owner. Instead of guessing, professionals look at 2 key numbers. First, they check the total value of every single share the company has issued. Then they look at how much investors are paying for every pound of profit the company actually makes. These numbers act as a reality check against the chaos and hype you see on the New York Stock Exchange floor. Now we reach level 5, commodities. Look at this massive oil tanker. Commodities are the raw, physical materials that build our world. We are talking about energy like oil, metals like gold and copper, and agricultural goods like wheat. Historically, physical commodities like gold have a unique relationship with regular stocks. When global economies panic and the stock market falls, investors often rush to buy physical gold as a safe haven, driving its price up while everything else drops. Stepping off the broad index fund path to pick single stocks or physical commodities moves the responsibility for research and risk directly to the investor. You are no longer relying on the general progress of the economy, but on your own ability to pick the winners. Level 6 takes us to the frontier, cryptocurrency. Think of this space as an unsupervised financial playground. There are no traditional safety nets here. The potential upside is massive, but the danger of losing your entire investment is extreme. The reality is that over 95% of all cryptocurrency projects eventually drop to zero. Taking investment advice from social media influencers in this space is a near guarantee that you will be left holding a worthless asset. Level 7 is angel investing. This is when you fund a very early-stage startup idea in exchange for a large percentage of any future profits. You give them the cash to build the product before it even exists. Because 9 out of 10 startups fail, the UK government offers a program called SEIS to encourage people to take the risk. As this breakdown shows, if you invest £10,000 in a qualifying startup, the government effectively offsets your taxes, shrinking your actual personal risk down to just £2,500. Finally, the top step, level 8, private equity. This is like buying a rundown shop, firing the management, aggressively renovating the interior to boost sales, and then selling the improved business for a massive profit. Private equity firms do exactly that, just with massive global corporations. These firms use a concept called leverage. They use a small block of their own money, but borrow heavy amounts of money from banks to buy the target company. Like a physical lever, that borrowed debt dramatically multiplies their potential profits. But if the business fails, that same debt multiplies their losses. These highest steps on the escalator are strictly reserved for capital you can comfortably afford to lose completely. They require specialized access, immense research, and very deep pockets. Now that we can see the entire length of the escalator, we have to answer the most practical question. How should an ordinary person actually divide up their own money across these steps? Think back to the numbers. 90% of professional experts lose to index funds over the long term, and 95% of crypto projects eventually vanish. Because the failure rate at the top of the escalator is so high, the math suggests most people should keep 80 to 90% of their wealth in those boring, reliable index funds. A low-cost global index fund, tucked safely inside a tax-free ISA, remains the single most effective tool for building wealth. It provides a way to capture the growth of the world's most successful companies without needing a finance degree. Achieving true financial freedom is not about fighting your way to the most complex, high-risk step at the top of the ladder. It is simply about relentlessly mastering the foundations at the bottom,